Chapter. We're talking real money.
Sure, buying a home or remodeling it or talking about politics, those things are cool and fun and all, but the really meaty talk is yet to come. The really important stuff, the money stuff, is about to be discussed on a show that is aptly titled Talking Real Money. With me, Don McDonald, and that guy in the laundry room, still Tom Cock.
The day is getting closer.
Are you going to get out of the laundry?
I believe I am. I've already given somebody a little bit of money. I think they're going to run cord from here to somewhere, and I'm going to get the heck out of this place.
Until then, your wife's just going to set the ironing board up in your studio then.
Wherever it is.
Wherever it is.
Yeah, all right.
Welcome to the program. We want to help you deal with money. That is really our goal. That we share stuff with you that we find interesting about money and investing, but our primary goal is really to help you out. That is why every Saturday we take your calls at 855-935-TALK, 855-935-8255. Even if you hear us on a podcast during the week, we're still Saturdays taking calls on Northwest News Radio in the Seattle area at 855-935-TALK from noon to 2 Pacific, 3 to 5 Eastern. So call us during those times. It's really easy. It's absolutely free. And we really do want to share with you things that you can use. You may not think they're the best answer, but we believe they're the best answer you're going to get. 855-935-TALK is our phone number, 855-935-8255. And one of the most powerful pieces of advice we provide is the fact that you cannot know the future. You cannot know it, which is why we insist that every investor, including our clients, rebalance their portfolio on a regular basis. Otherwise, your portfolio, just through inaction, is destined to get all out of balance, and it increases your risk.
And the people that study this closely, the academics who look at the numbers, are going to tell you that the stock to bond ratio, the percentage of money you have exposed to stocks and the percentage of money that you have exposed to bonds, will be the greatest determinant of how much money you make and how much money you can lose. It's not picking Tesla over Amazon or deciding, to have this much in small cap and value. Those are important things too. But the biggest is this balance between the risky things and the less risky things.
Hold on. Before we go any further, I need to interrupt you for a mere moment. This is an important message. You just said that Tesla choosing the right stock is an important issue.
No, I said, no, it's not. This is more important than picking
more
the
important.
Right stock.
The stock picking should be out of your vocabulary.
The biggest determinant, according to academics, is your stock to bond ratio. I was suggesting that it doesn't matter if you think you're really smart and you pick the right stock. And here's the thing to
clear it up so that we didn't sound like we were stock pickers.
No, we're not stock pickers. Here's the thing that's fascinating to me. If you ask 100 people that are investors what their stock to bond ratio is, that is how much you have in stocks and how much you have in bonds, it'll be about 97% that get that wrong. Because I get to see all your portfolios every week. And one of the things I do is I ask, how much do you have in stock? And most people, they scratch their head because they have numerous accounts, because sometimes they have people managing it. Sometimes it's in a target date fund. They just don't know. They don't understand that that's so important, and they don't pay attention to it. And here's the other thing that's absolutely amazing. So 78% of the money that's invested today is in stocks, and only 22% is in bonds. Now, that may sound all right. That's across the board? That's across the board, according to the study from Morningstar.
Wow.
Which may sound okay, but I'm telling you, here's the thing. The reason I don't think it is for most people. It is for Don and I. I think I'm still about 80%, 81.
I'm not.
Okay, I don't know where your risk capacity is.
Well, I'm just getting old. It's not even risk capacity anymore. It's, do I need to take it?
Yeah, exactly. So if you're in a portfolio of that much risk, you need to be prepared for a loss of somewhere around 30% if the future looks like the past. So be ready. We'll talk more about this.
Yeah, or more. Rebalancing is really important for a variety of reasons. and we're going to talk about them. 855-935-TALK.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
If you've always wanted to call us on the show, well, now would be a very good time to do it. Because we've got lines open, and it's really easy, and it's absolutely free and a breeze at 855-935-TALK, 855-935-8255. We take tons of questions from people every week, but Saturday is the only time we have available to have a conversation during the show /podcast. So give us a call, 855-935-8255. And I'm shocked. I'm really shocked that so little of American investors' money is in bonds or bond products. I would have thought it would be more, and apparently it's I don't understand it.
Well, and you want a dollar amount? I mean, according to the author of this article in Morningstar, it says, I estimate fund investors are overexposed to equities, stocks, and underallocated to bonds by about $800 billion with a B dollars.
That's almost $1 trillion.
That's a whole lot of money. And this is way more stock exposure than it was a decade ago. I mean, that's one. Here's another one that's
sounds scary to me, and
it does.
Particularly when you consider how much of the wealth of American individual investors is in the hands of people who are at or approaching or in or approaching retirement, when you probably should be more conservative.
Not just because as we get older, we don't want to worry about it so much, as because you're going to need stability to draw from the portfolio. Volatility is a bad thing when you're trying to pull it.
And to avoid the panic that inevitably occurs, even with people who are certain they have a strong stomach for volatility. When it really happens, it tests you, and many fail that test.
And not that long ago to remember, right? Wasn't it just 2022? And then we had the spring of 2020 with that COVID thing. And I mean, you can go back through history, and I've talked to many of you on the phone when it's been bad. But boiling it down even more, you'll find this interesting. A decade ago, the U.S. to international split was 75-25. Now, 82% of stock holdings are in American stocks. America first, baby, and only 18 international. So that's even more risk.
That is such a great. Both numbers are great illustrations of our flawed psychology, our recency biases. We are heavily in stocks because, well, stocks have done better than bonds. Have done better. Have, past tense, done better. We're heavily in the U.S. because, well, the U.S. market has outperformed international markets. Has outperformed. Past tense. Do you, and this is an argument I have with all kinds of people I care about. I'm not naming names, but do you have a single solitary absolute clue what the future is going to hold? Why do you keep betting on the future as if it is going to be like today? It's not. It's going to throw you a curve. You just don't know when or how big.
That's recency bias. I'll give you my 3 points. You've got to know what ratio you're trying to achieve. That's one, because most people don't, between stocks and bonds. You got to know what rate of return you need in your portfolio, and you need to know part 3, and I think we offer this free on the website at the risk quiz. You got to know what your risk, your tolerance for the ups and downs is. As Don said before, it gets ugly and you find out the bad way. That's what I see happening a lot.
And it goes back to put all those together. This is why you need a plan. You got to have a plan. 855-935-TALK is our phone number, 855-935-8255. Let's go out to Pennsylvania. And Perry, welcome to the program. That's a lot of P's and no plosives.
Perfect.
You had the plosive.
You were waiting for one, so now you got it.
All right. What you got, Perry?
And Tom.
You can ignore him. He plosived.
My family has my family has an LLC, and it's been in probate for 8 years or whatever. it's finally going to get dissolved. Do I get any step up on that stuff, or is it just as is?
Yeah, no, you get the step up from the time it was it moved from one party to another. That's all. No,
it's time of death. It's
time of death.
Yeah.
I was always in it.
He's part of the LLCs. That's what I see. I was going to be hesitant because he didn't inherit the LLC. The LLC is just being dissolved.
Nope.
Therefore, you were a beneficial owner of it.
Yeah.
Therefore, you do not get it. My understanding, I'm not a lawyer, okay, but my understanding is you do not get a step up because you already owned it the whole darn time, and there were advantages along the way to you owning it the whole darn time. Probably that's why it was set up for some tax advantages.
Well, I mean, I never got to decide what it was in.
Yeah,
so it was always in a large amount of bonds and hodgepodge.
Yeah,
so it's just a mess to try to clean up at this point.
Yeah, the main reason for a family LLC is for asset protection.
Yep.
And there are some tax advantages along the way, but you do. My understanding is you do lose that step up in cost basis. But since it wasn't a very clean portfolio anyway, and you got a lot of bonds, shouldn't be too big.
No, but I'm too heavy in bonds, and I want to dissolve it and get my assets, properly diversified. And
but bonds generally pay out all of their return in dividends along the way, so you shouldn't have a big capital gain to worry about.
No, but should I wait until those bonds mature, or should I get my assets?
Need the money?
Properly diversified?
No, he wants to properly diversify.
Then so I would be selling.
And what you do is tax plan the sale. Are there any of them really long-term bonds?
I don't know all of them. Like I said, it's a really hodgepodge, and I don't know what I'm getting because it isn't broken up, so I'm not sure. I'm not sure exactly what I'm going to get.
Sir, you need a true
Morgan, and I don't want to use them.
You need a true, you don't want to use them. It's don't. You need to find yourself a true 100% fiduciary advisor, at least initially. And how old are you?
43.
Oh, wow, young. You probably want somebody to at least help you plan out the distribution, the sale thereof, and the reinvestment thereof. I
think that's good. Yeah. Mm-hmm.
What is your guys' initial? Not initial. I know you guys do an hour consult, but what is your bottom dollar that you guys will work?
How much?
What are our fees?
Oh no. Yeah. How much? No, how much? He wants to know what our minimum.
How much?
Oh, our minimum.
Yeah.
What is our minimum? I don't even know anymore.
Technically, it's $500,000.
But he can
because
he has powers.
I do not. Okay, I just want to say this. I've said this. I don't turn anybody away from. First of all, we're going to give you all the time to make sure you're doing right. And if it turns out you need help and it's less than that, I'm still going to take you on as a client if you need the help. So they can have their number. I got my number. So I'm sure this will do well back at headquarters.
Yeah, I was going to say, now the cat's out of the bag.
Yeah, exactly. So.
Oh, no wonder.
Yeah, okay. That guy. Mm-hmm.
So Tom, just call Tom.
Yeah, exactly. No, we're going to, again, we make sure anybody's taken care of.
We do. We actually,
hire us or not, period.
Even in that 1 hour consult, you can probably get enough information to be able to figure out how you should do this, because the bonds have to be looked at one at a time to see which are the best ones to unload today to start investing in equities.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
You're suspicious, and I don't blame you for being suspicious.
I think you should. It's your money.
I don't blame you at all. It's funny. We got a review from a guy who said that he liked the show, but we suggest these obscure funds that are that charge high fees and.
Wait, what high fees?
Avantis and DFA.
Oh, well, compared to Vanguard, they are more expensive. Yeah. And
he thinks we're getting obscure. He thinks we're getting a kickback.
We don't get anything from those guys. So
I don't get any kickbacks. We get paid by Apello Wealth. We'll tell you that. I get a paycheck. Yeah. I do, because I'm doing this. This is my job. But
hard to believe it's a job.
Yeah.
But okay.
Hey,
sorry.
We do it well.
Okay.
But I wanted to to let you know that it sounded like a pitch when we say, Tom or one of our advisors will meet with you for an hour. And no, they really just meet with you. They don't try to sell you anything. I mean, Tom, guessing. I know this is, I took you totally off guard, caught you off guard. Just guessing during the past year, how many people would you guess you've talked to who never became clients?
Wow, that's a great question. I'll say 100.
Okay.
I talk to a lot of people. So, I mean, a lot of people have like one question, or a lot of people say, I got this, and this. So,
and you go through their portfolio with them, and
some need help and some don't. And some are just like, no, I just need you take it over and fix it, et cetera, et cetera. And some say that's never going to happen. So, and it's all fine.
And if they say it's never going to happen, it's okay. We're good with that. 855-935-TALK is the phone number here. I'm Don. That's Tom. And you ask us questions all the time. Tom's got like 33,000 of them in his inbox. A lot
of questions, yeah.
All right,
so let's try to get to a
little, maybe 33.
Yeah.
But let's do a couple. Yeah, let's do one.
James says, I'm 33 years old with a high-risk portfolio and a long-term horizon. That's good. He has a $2.5 million loan on a commercial building that his business just moved into in 2024. 4 other tenants as well. I occupy one of the spaces. Here's the gist of the question. He says, I max out my 401k plus profit share, my backdoor Roth IRA for me and my wife, and automatic investments into our taxable brokerage account. However, with the excess money at the end of the month, I typically shove into my taxable account. But having such a high debt on the commercial building, I've shifted to paying off that quicker. The loan is split into 2, both roughly 6.8% interest, with one being 10-year, 15-year amortization, and the other being 25-year amortization. Due to having that guaranteed 6.8 return by making extra payments on the loan, I was thinking of updating my plan to use excess money by applying 70% as extra payments on the loan and 30. So in other words, 70% of the he calls extra money, cash flow is what I would call it, into the loan pay down, and 30% into the investment account. What say you?
Well, he's right. It's again, I'm going to make some assumptions. I'm going to assume that he personally owns this. Because that's what it sounds like.
Sounds like that, yeah. Says that.
So if he personally owns it, the debt is his obligation, although the debt is offset by the asset if something was to happen, and it depends on the recourse nature of the loan and things like that. The only downside, this is the big downside, the 6.8 is great. That's a very good riskless return.
Sure, yeah.
However, your money is going to be really hard to get at should you need it. Harder than your home, probably, because it's commercial.
Yeah. You don't know the marketplace, owning one property, all those things that make it difficult sometimes to sell a house are even more significant when it comes to commercial property. I have to agree there.
But given the fact that you said you have a high-risk portfolio and that you're a younger, higher risk-taking investor, think about this for a minute. That money that you're investing in that taxable account, if you're investing it in ETFs that are growth-oriented ETFs, they've got a tax advantage in that they probably won't distribute capital gains. So you got some tax deferral there. You have access to the money, and historically, if you are properly diversified, U.S., international, small value, in addition to growth and all those things, traditionally, historically, your returns would have been 2 to 3 points higher than the 6.8.
Yeah,
so there are some downsides.
The baby, he's doing a little bit of both. I love that.
Yeah, doing a little bit of both is fine. I wouldn't reallocate all of that extra money, but a portion of it, sure, splitting the baby. 855-935-TALK is our phone number. The calls are pouring in now. 855-935-8255.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
In other words, it's the Doe Show. And I'm the D.O. in the Doe Show. Don, and Tom is the T.O. in I don't know. 855-935-TALK is our phone number, 855-935-8255. And Perry from PA called back because he has another QA. No, Q for us to A. Go ahead, Perry. Perry dropped?
I'm not hearing him.
Okay, then. We won't talk to Perry.
Sorry, Perry.
I assume Jason is still there, right? Okay, we're going to Sammamish then instead. Jason, you're up. Welcome to Talking Real Money.
Good afternoon, gentlemen.
Hello, sir.
I want to challenge you on both of your assertions. So first of all, stocks, the upside of stocks has so dramatically outperformed, I would say historically, not just recently, historically, bonds, that would offset any, I think Don talked about 30% downside, if it was you, but 30% downside. And I think that would, the growth potential of stocks over bonds would largely offset that. Not entirely, largely. That's the. Well,
we don't disagree. We don't disagree with that. Here's the problem.
Okay.
And believe me, we've talked to tens of thousands of people.
Talked to people crying in 2022.
Yeah, and let me tell you a question that we asked after the 08, before and after the 08 crash. How many of you would be comfortable with your $1 million portfolio dropping by $500,000 and you have no idea if or when it will recover? Do you know how many hands went up that they could take that?
Probably not many.
Not any.
Zero. No one is okay with that.
That's the reason. That's why bonds, no other reason. They have no earning potential.
Let's just set the record straight in terms of historical returns perspective-wise. Yes, stocks, again, big picture, long-term have made about 10, but bonds, which have been really lousy the last decade, long haul have made somewhere about 5. So it is a 2-to-1 ratio, but for the reasons that Don just described, for most people, it should be in their portfolio.
Yeah, but I'm not talking about 1 year. I'm talking about over 50 years, stocks versus bonds. I mean,
right? No, and again, we're not disagreeing.
100%. Yeah.
Here's the problem: is the short-term psychology. That's the problem.
Yeah, I get it.
Now the problem is we all speak from our own personal biases. You, and by the way, me.
I'm 98 too. I'm 98 too in equities. Yeah.
I was 100% in equities up until 10 years ago.
Yeah.
See, but we're talking to the vast majority of America, and we know that the vast majority of American investors cannot suffer through a 50% decline without doing something stupid.
That's the issue right there. People will say they can, then the market will go down even 20, 30%. And guess what they will do? They will time their way out. They will sell, and then they will wait for the market to go back. There's all kinds of people that have looked at the actual numbers, and they can show you that clearly that's why investors underperform just stock indexes.
All right, and your other assertion, remind me again. I know I had a challenge for it. What was your other assertion again at the top?
Make a lot of
international. That you needed international in a portfolio.
Yeah. Okay, yeah, this is a favorite of mine. Okay, so
we got the answer.
Well, I'm sure you think you do.
No, we do.
Over the last 100 years. Okay, over the last 100 years, right? Let's just think about the last 100 years.
Okay, first, we don't have 100 years of data on international. It only goes back to the 70s.
Okay, well, fair. All right, so since the 70s, we have to think about, again, cost. Who do we think is going to outdo the United States? Short of the collapse
of the
total collapse of the dollar, short of the total collapse of the dollar, I see zero reason to invest much in international. It's just.
Where were you? Okay, we got to ask you though. Where were you on Japan in 1990 then? Because they had the largest stock market. They'd had a decade of outperformance. They were the manufacturing genius. People were using their management styles. They were running all the money into Japan.
Oh, I got a better one. But I got to wait till after the break. So you got to stay right there. Hang on for a minute. I got it. I got the answer. We'll be back. 855-935-TALK is our phone number. Don't go away.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Welcome back. Hey, our phone number is 855-935-TALK. I'm Don. That's Tom. And Jason's on the line with us, taking us to task for our advice to diversify your portfolio with bonds and with international stocks. Now, Jason, the question I want you to answer right now is, over the past 20 years, actually 20 years through the end of 2023, because we don't have the 2024 numbers done yet. Through the end of 2023, over the previous 20 years, how many times was the United States the best performing market in the world out of 20 years?
I'm sure you have it.
I have it in front of me.
Me.
I have it in front of me.
But I don't. Yeah,
one.
I'm sure you have an answer that's going to surprise me, but
the answer is one. Yeah. One. Did you know that in 2023, the best market in the world was Italy? Do you know that Denmark, the average annual returns for a portfolio from Denmark are 40% higher than the returns for the U.S. market?
That's before the Greenland thing, though, so we'll have to see.
Hold on. When you say market, are we talking about companies that are? Because I don't know of any Italian
stock
companies
markets.
that outdo Google, Microsoft. Yeah, but what companies are in these stock markets? Because I don't know of any Italian companies that.
Fiat?
Sure you do.
No. But we're not saying they're outperforming Google or Apple. We're saying that in aggregate, that market returned more money. And here's the real meat of the matter. Let me just.
Yeah.
There was, and I don't know how old you are, but between the year 2000 and 2010, the U.S. market, as represented by the S&P 500, lost 1% per year.
They call it the lost decade.
If you were invested globally, half in U.S., half in international, your average annual return over that period would have been about 7% per year.
Yeah, it's a fair argument. It is.
Yeah.
Again, we have to talk about the fact that the great financial crisis was. You can argue. I know you're going to argue with me on this, but you can argue that was a once in a lifetime type event. But
I don't know.
No, we're not going to make that argument.
I remember a horrible market in '87. I remember one in 2000, 2001.
74, 75.
74, 75. I forgot. I was just a
2020, 2022.
But those didn't compare to the GFC. Though. Those were minor in comparison to the GFC, I would say.
Not the people who were in them at the time. And by the way, the one that challenges it is 1929.
I agree. That one does, for sure.
So, but again, we're not arguing that the U.S. isn't a great place to invest. As a matter of fact, we both have home field biases. We like the U.S. Right. We think the U.S. is the best economy. We just don't think it's the only one.
No, and we would prefer to be diversified because we don't know what the next 20 or 30 years holds.
And here's the difference, Jason, between what we preach and what you're saying. We're not looking for home runs. We're looking for singles.
Understood. You're the Ichiro, yeah.
Yeah. All right.
Works. You end up in the Hall of Fame. Yeah, there you go.
We appreciate it. 855-935-TALK. That's our phone number. We've got lines open for you right now. Let's go to Wisconsin. We love Wisconsin, just not this time of year. Right?
Stop it.
Todd, welcome to the program.
Hi, guys. I got a quick question about a 401k plan. I'm going to be retiring at 53, and my wife will be 57. And I was wondering, is she able to pull out of her 401k before she's 59 and a half?
Yeah, you can take the, what's that
substantially
rule?
Equal distributions over your life expectancy. Yeah, the IRS actually does have a rule to take that into account.
I think that's 55 on that one. I remember.
Yeah,
right.
And you have to take the withdrawals. You have to take what are called substantially equal withdrawals over your life expectancy, which means you have to use the life expectancy tables, and then you take a certain amount out every year, and from then on, no less than that.
And
you can go above that, but you can't go below that.
I wouldn't do it without very careful planning either, because most of the time we look at portfolios, people that start before 60. It's a long way to have that money last. So I would really look at those numbers carefully.
Yeah, if this was 150 years ago, we'd say go for it. But because you would have been dead by 65 anyway.
That's a good point.
But now you'll be alive probably into your 80s, maybe 90s, and boy, that money. But again, you can start taking a little out. You just really need the plan has to be a lot more precise when you retire early.
Just kind of a little background. So when I retire at 53, I'll have a $7,000 pension, and then my wife will have $950,000 in her 401k, and I'll have $400,000 in a 457. So then
you guys are good savers.
457.
Yeah, I mean, can you live on the pension?
10-year-old car.
Can you afford just to pay the bills?
Oh yeah, we could easily live on just a pension. But I kind of agree with you guys that a 5% flexible withdrawal every year is really the way to go, because if she turns 59 and a half and I can take 5% out every year, that's a big amount that we could take out also.
Yeah, if it's invested properly, you got a well-balanced portfolio, taking out $40,000 to $50,000 every year from her portfolio should not have a huge negative impact, at least based on the numbers we've run on all kinds of scenarios, going back or going hypothetically forward based on all kinds of past scenarios.
I think they're all up on Paul Merriman's website still. You can go look at them all those.
All those outcomes.
Yeah, I think he goes all the way up to like 6% even.
Yeah. And I don't disagree with that even. It just requires that you have more flexibility in spending. Whatever, the more you raise the number, the more the worse the downsides are likely to be, because you've done a lot of drawing down in bad markets.
Mm-hmm. Okay. Yeah. Because I agree with most of everything you guys say. Like the other guy, the only thing I wouldn't say disagree with, but you say that kind of weight off on Social Security as much as you can. But I think a lot of people take it at 62 just for the simple fact that they think they're going to spend more between 62 and 72 than they will between 72 and 82.
We don't argue with that, but here's the argument. Again, it's just, I will make, and I'm going to make this at retirement in a couple weeks. One party should wait until 70 so that the surviving member of that couple, whoever lives longer in that couple, will have that bigger benefit. I just think that's a no-brainer to me. What you're saying is, hey, we may need the money to spend between 62 and 70. Sure, I get that. But the numbers are going to look better over the long haul if you can afford to wait.
And I have a question that I'm going to raise at Retire Meet, and that is...
Not with me, I hope.
No, Todd, what are you going to do when you retire?
Yeah, that's a long time.
Really, we're talking 30-plus years in retirement.
Plans?
What are you going to do to do?
I think the only thing I have that we've planned a lot, me and my wife, is that both of us are retiring together.
Yeah.
I see a lot of people that I work with because, being in like law enforcement, you're able to retire early, and everybody returns back to work because they have nobody to retire with.
Okay, I hope you guys have.
Opposite,
I hope you guys have plans for busy days.
It's a long
because
time.
That is a long time. So I just want you to think about it. 855-935-TALK.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Life after retirement is something that I know I have given a great deal of thought to. A great deal, because I am past FRA. I am 68 years old. But the thing that keeps coming up, Debbie and I sit and talk about it. She goes, well, you should retire someday. I said, what am I going to do? Well, you could do more work around the house. I went, I'm going to keep working.
Yeah, my wife's made it very clear, and this is no joke. She has made it clear that if I retire and I'm home more during the day, she's still only going to love me 90 minutes a day. I mean, it's just like it is today. It's not going to be. That's it, dude. That's all you get. So
you got 90 minutes in the contract.
Yeah, that's all. So all kidding aside, purpose, need, all those things are exceedingly important, underrated in retirement. I think
purpose. I honestly think purpose is underrated. I think that we think, men and women, because we all are working now, that I think sometimes we think, I am just going to have fun.
Yeah.
Well,
Golf,
what is that
beaches.
fun? Are you going to really, seriously, you want to golf every day? Have
Some
you tried
people
it?
do. Yeah.
Have you tried it every day? You know, books are fun, but you want to read a book every day. Although I have to tell you, maybe with my Vision Pro, I would just retire.
Yeah, you might, but
No,
I'll read more.
I'll tell you
read
what.
More.
The other day, I thought, oh my gosh, I forgot all about the House of the Dragon. That
would be pretty amazing in those things.
The sequel to Game of Thrones. And so I started to watch it, and it went immersive environment on the screen. I went, oh, I wonder what that is. And I punched the button, and it's the Iron Throne Room. You can watch the show on a 30-foot screen in the Iron Throne Room in full 3 dimensions. I can look around 360 degrees.
That sounds scary to me, but I'm glad you enjoy it.
I go from my little tiny office to this room that is probably
cathedral
50,000 square feet.
Yeah.
And it feels like I'm actually sitting in that giant room. It echoes. When I stop listening to the show, I can hear the sound of some bird that's caught in the cathedral area, the big giant space.
We're going to return to Earth now and mention that there are still, so they're making a liar out of me.
How many seats?
It's like 10. So
okay,
I said it'll be all over. But yeah. So anyway, so if you'd like to join us 2 weeks from today, to those of you listening to the live broadcast on Saturday, February 8th for Retire Meet 2025, get in there and register right now. So that's
Maidenbauer Center in Bellevue.
Yeah. We'll be there, et cetera, et cetera.
Lots of people talking. I'm starting things off, then Tom follows, and then we run away and let other people talk. We don't know.
Good luck.
But you can go register right now at retiremeet.com. That's retiremeet.com. And it's not expensive, particularly when you figure you get fed if you're at the
breakfast
live one at Maidenbauer.
Both.
It's $5 for the virtual one. You don't get fed. We have not figured out a way to shove sandwiches down fiber optic cable.
Coming, though.
We're not. It's not there yet. I can't even get roasted meats in the Great Hall at the Red Keep.
You can get roasted dragons, though, probably.
Roasted dragon.
Yeah.
If they could do that, if you could smell the fire and brimstone and feel the heat, that'd be kind of cool.
It's probably coming, so pay attention.
Cool. And if you want to ask us questions, call us at 855-935-TALK, or you can ask questions by going to TalkingRealMoney.com. Click on the button that says Contact Us and type them or speak them.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.